As the U.S. markets are currently closed on Thursday, October 23, 2025, we are looking at the closing figures from yesterday's session. Applied Digital Corp, trading under the ticker APLD, finished the day on Wednesday, October 22nd, at $4.15 per share. That was a drop of $0.10 or 2.35% for the session. Now, the immediate expectation for many people when they hear Applied Digital is to instantly lump it in with the crypto mining craze. For a long time, that was the entire narrative. You bought this stock as a pick and shovel play on Bitcoin, plain and simple. But the reality of what's happening with this company right now is so much more complicated and, frankly, so much more interesting than just the price of a digital coin. That 2.35% slide isn't just random market static, it's the market actively trying to price in the enormous risk and potential reward of a company attempting a full-scale identity change, moving from the volatile world of crypto hosting to the high-stakes arena of artificial intelligence and high-performance computing HPC data centers. And their most recent earnings report just threw a lot of fuel on that fire. Let's establish the common ground, the story that got a lot of people to buy this stock in the first place, maybe using their Robinhood app or a SoFi Invest account. The expectation was straightforward. Bitcoin and other cryptocurrencies need massive computing power to be mined. Applied Digital built and operated the facilities, the data centers, to host those mining machines. So as crypto prices went up, demand for hosting would soar, and APLD's revenue would explode. It seemed like a safer way to play the boom, and we saw the stock price react accordingly during crypto bull runs. It was an easy story to sell, an easy story to understand. But here is the challenging reality that supersedes that old narrative. The crypto hosting business is tough. It's low margin, highly competitive, and tied to an underlying asset that is famously volatile. The leadership at Applied Digital knew this, so they began a very expensive and difficult shift. They are now focusing on building next-generation, high-specification data centers designed specifically for AI and HPC workloads. Think about the hardware that powers the AI boom. We all know about NVIDIA stock and their incredible run. Well, those GPUs need a home. They need immense, stable power and specialized cooling far beyond what a simple crypto mining shed can provide. Applied Digital is trying to become a landlord for the AI revolution. This is a much harder business. You're no longer competing with small-time operators. You're now in a field with global giants, data center REITs, and the cloud providers themselves. Let's dig into that recent price action, because that $4.15 close tells a story. The stock has been under significant pressure, and the catalyst was its recent fiscal first quarter earnings report. On the surface, the numbers looked like what the bulls wanted to see. Revenue beat estimates, showing a massive year-over-year growth rate of over 240%. If you're a new trader on the Robinhood stock trading platform, you see that 240% growth and you hit the buy button. But the deeper reality, the one the institutional money is watching, was in the earnings per share. They missed. They lost more per share than Wall Street was anticipating. This is the central conflict for the stock right here. They are growing the top-line revenue at an incredible pace, but they are also spending an enormous amount of capital to build these new, expensive AI data centers. This heavy capital expenditure is burning through cash, and the market is getting nervous about future debt and the possibility of shareholder dilution, selling more stock to raise funds. That 2.35% drop is part of a larger pattern of volatility. The stock is currently trying to find a stable floor after a significant decline from its highs earlier in the year. When you see heavy volume on down days, it suggests some larger funds might be trimming their positions. But here's the other side of that coin. APLD has a very high short interest, hovering around 20% of the public float. This means a significant number of traders, many of whom are likely using sophisticated platforms like interactive brokers, are betting heavily that the stock price is going to fall. This creates a tense, coiled spring situation. Any piece of really good news, like their recent announcement of a new 100-megawatt hosting contract with a US-based cloud provider, could trigger a short squeeze, forcing those short sellers to buy back shares at any price to cover their losses, sending the stock flying. On the other hand, any bad news, like a construction delay or a major client backing out, could validate the shorts and cause a sharp drop. This is not a stock for a passive investment. It's not something you just park in a diversified portfolio like one of the Fidelity ETFs or Fidelity mutual funds. This is a highly speculative, active management type of name. Your experience with this stock will be very different depending on your tools and your strategy. An investor using Fidelity or Schwab Intelligent portfolios for their long-term retirement goals is probably not holding a large concentrated position in APLD. Their investment help is geared towards diversification. But the day trader, the person looking for online investing ideas with high volatility, is watching this stock every second. They're using the Fidelity trading platform or the SoFi trading platform to watch the order flow, looking for an entry and exit. This isn't your slow and steady Apple stock or even the growth story of Tesla stock, both of which have much more established and understandable business models. APLD is a construction site, both literally and financially. So let's be perfectly clear on what the company does now. It's really three businesses. First, the legacy crypto hosting business. This is still bringing in cash, but it's volatile, and the company is not emphasizing it as the future. Second, the high-growth HPC AI data center. This is the entire bull case. They build the giant, power-intensive shells, and clients, like AI startups or cloud companies, come in and install their servers and GPUs. APLD provides the space, the immense power, and the complex cooling solutions. Third, they have a small emerging cloud services segment. The entire future of that $4.15 stock price rests on one thing: their ability to fill these new HPC data centers with long-term, high-paying, credit-worthy clients before they run out of money or the capital markets turn against them. It is a race against time and their own balance sheet. This market confusion isn't new for APLD. Look at a long-term chart. You'll see massive parabolic spikes followed by devastating crashes. This is the signature of a stock story, where the market can't decide what it is. One month it trades like a crypto stock. The next it trades like an AI infrastructure stock. The expectation is constantly shifting. When you compare this to the online investment profile of a blue-chip stock on Fidelity Investments, the difference is night and day. If you use your Fidelity mobile app to check your Fidelity brokerage account, you want your core holdings to be stable. APLD is the opposite of stable. It's a high-risk bet on a corporate transformation. This brings us to the future outlook. What are the two opposing paths from here? The bullish expectation is that Applied Digital is getting in on the ground floor of the AI infrastructure build-out. They are a pure play on data center demand. Bulls will point to that Needham analyst, who, despite cutting their price target from $10 to $8, still maintains a buy rating. They see that new 100-megawatt contract as concrete proof that the "if you build it, they will come" strategy is working. They believe that if APLD can just execute and hit its 2026 guidance, the stock isn't just cheap at $4.15, it's a multi-bagger. They see this as a chance to get in on the next NVIDIA stock, but on the infrastructure side. Now for the cold water of the reality check. The bear case is just as compelling. And it's built on 3 pillars. First, competition. This is not a friendly space. Applied Digital is building data centers, but so are Amazon, Google, Microsoft, Equinix, and dozens of other heavily capitalized players. It's a war fought with billions of dollars. Second, financing. Building these facilities is astoundingly expensive. APLD has to get that cash from somewhere. In this higher interest rate environment, taking on new debt is costly. The alternative is selling more stock, which dilutes the value for everyone who currently holds shares in their SoFi active investing account or individual brokerage account. Third, and most importantly, is execution risk. Can they actually build these highly complex facilities on time and on budget? Any delay, any cost overrun is a disaster for the financial model. This is the central question, and it's what the market is fighting over. I want you to comment below with your answer. Do you believe APLD